A very good evening. It's always a pleasure having you join me for the Capital Market Bridge Show. My name is William Evans. Now, I want you to imagine having your money become an income stream without working extra hours, but making your money work for you. Now, that is the promise of the capital market or the stock market. But to many, this market still remains complex. It remains very risky, but also a preserve for very few people. Now, tonight, that is a conversation we have. We break it down. What does the stock market actually mean? How risky is it? Is it complicated as people think? Or is it a preserve for very few? Well, to have this conversation with me is Miss Musoni Diana, who is in charge of wealth management. Diane, welcome to the show.
Thank you very much. Pleasure to be here.
We begin from wealth management. What does that involve?
I manage wealth, I manage clients, portfolios. Yes.
Perfect. For someone that is actually listening to us for the very first time, they've always heard that stock market is complex, it's risky, it's reserved for a specific group of people. From where you sit, do you hear such conversations quite often? What sort of misconceptions are around the stock market that young people need to know today?
Absolutely. So we do hear a lot of investors walk in and they think that you should have an amount of money, a certain amount of money to start investing in the stock exchange, which is not true. So with the stock exchange, the risky part is basically how volatile the market is. So which would not really apply on our stock exchange. Our Rwanda Stock Exchange is still growing. It's been there for a few years, and not so many people are very aware of what the stock exchange does. So for a stock, it's basically having a share in a company, and there are two ways in which you can earn on the stock exchange or in shares. So the first one is what we call capital gain. So one would ask, what is capital gain? So if I'm buying a stock today of BK, and the price right now is at 460 francs. 460 francs. So if you're buying, the minimal amount of shares is 100. So that would be 46,000, right? You can start with as little as 46,000. And if the price in 6 months now goes up to 480, already the value of the stock that you hold has gone up, right? And if you were to sell the stock, you would now get it for 2,000 more than what you initially paid for. And the second one is dividends. The dividends is basically if a company has made their profit, and of course they have to pay their shareholders because that's why you injected the money in the business. They pay you every year. Sometimes there's a special dividend called an interim, which is paid in December. So the risk would be the same way we are earning on the share is the same way we can lose. So the stock could drop. The price could drop from 460 to like 420, and the value has dropped. And if the company does not make a profit, then it will not pay dividends. So those are the risks that are into shares. We usually classify it as a high-risk investment, but you can start as little as less than 50,000, really. Yeah.
There raises questions, of course, if it is involving money, if it is involving exchanges, buying and getting this. There are questions around regulation, there are questions around liquidity, there are questions around protection. In the sense of, let's say someone has bought 100 shares from BK where you sit. What does regulation or investor protection and liquidity now mean to them? What does it look like?
So basically, those are three different components. So there's liquidity and then there's investor protection. Let me just classify it in investor protection. So the investor is already protected by us, the broker. So we are supposed to be performing at your best interest. So whenever we have your order, we're supposed to execute it in your best interest, in the client's best interest, whether they're buying or selling. And we are regulated by the capital markets and also the stock exchange. So we cannot make you go into a loss if the price of the stock is already on the market. So we're supposed to execute it as the client wants. And in terms of liquidity, our stock exchange is still growing. So we have a lot of investors who sometimes suffer from lack of liquidity. So I'll give an example for now. There are two stocks, so Braidwa, Beka. Their demand is really, really high, and the supply is a bit low. So people are hold when they buy, they hold. So for now, the investors that we have seen are investors that buy to hold rather than buy and trade, right? So sometimes the supply could be extremely low and the demand really high, and that could affect the liquidity or even vice versa. So some stocks like MTN, the supply has been really, really high and the demand has been low. So it just varies on the stock, basically, yes.
When you say that whatever you do, you execute in the best interest of the holder of the stock, or
Yes.
uh, are there instances where people that are holding the stocks are dreaming of having much more than you can actually deliver them, yet you have to execute in their best interest? Do you ever?
Yes,
What
but
happens in such cases?
so the our regulators, so there's a bracket we cannot exceed. So if the price is 460, for example, there's a limit it cannot exceed. So it cannot exceed like 10 to 15% of that. We're gonna, as your advisors, will tell you it's impossible to get a customer. If you're pricing it at 500 and there's someone who's selling it at 460, if I'm buying, I would buy it at a lower price. So yeah, we always advise them to at least be realistic, but also keep it in the bracket. So if it exceeds the bracket, we cannot.
What are we doing to make sure that a number of young people, a number of young people that have just started work 1, 2, 3 years into the workplaces can find confidence in the stock market?
So for now, we just have 5 locally listed companies. So we have BK, we have Braidwa, MTN, Simirgwa, and I&M. So if having more companies would actually mean a lot of people are participating on it. So for now, we're capped with a number of companies you can invest in. So that's one way in which the stock exchange is still growing. In terms of accessibility, we are still very traditional because you would have to still need a broker to execute the trades for you. But as BK Capital, we've made it very accessible for people. So we have gone digital, so that you don't have to come visit our offices. You don't have to go to the bank. Sometimes we tell them to go to the nearest BK branch. So all of that you don't need to do anymore. So we have a portal where you can log in, you can put in your trades. It shows you the current market price. So as someone who is starting, I would advise them to not think of like the easiest way to make money. So with stocks, it's more of a steady income. So it's more of a steady progression, a growth. So you cannot make money overnight, even though it's a bit. It could be possible, but we usually advise them to start small. Start with one stock, diversify. Don't put all your eggs in one basket. But with as little as less than 50,000, with MTN right now, you can with 17,000 you can buy 100 shares. So you don't have to have so much money for you to be an investor.
Definitely, we have more than the listed companies in Rwanda, right? Corporate companies. From where you sit, what do you think are some of the challenges probably that are making many of the corporate companies a bit shy?
With money, we can be a bit sensitive. So they need
Rwandans
that.
are always sensitive.
Exactly. So they need one-on-one advisory on which stock to put, which is also okay. You can also always walk into BK Capital where we have a client service team dedicated to that. But also for companies, I think it's about financial literacy. I always say there's a huge gap in financial literacy as a society in Rwanda. Some people don't know that you can have alternative ways of raising capital. So aside from stocks, raising stocks as a way of raising capital, we also do corporate bonds, so which is a debt side. So with stock exchange is more equities, and then with corporate bonds is debt. So a lot of corporates, a lot of companies, sometimes maybe they're not as comfortable to list their whole financials because they have to make it public.
Specifically for beginners, yeah, of course the encouragement is usually to begin small. And when you say begin small, what exactly are you telling them? Are you telling them to begin small in terms of how much they invest, or to begin small in terms of expectations of making money as quickly as possible?
I would say for both, actually. So starting small in terms of amount to invest, you can start with as little as 17,000. So if you can invest in MTN, you can invest in I&M, but also expectations. So a lot of people go in with the mentality of they want, capital growth, or they want dividend stocks. So I would say it's good to have these expectations, but also you have to keep an open mind that sometimes these companies are will not be able to get the profit that they thought they would get. So I would say start small in terms of expectations, but also expecting to grow. Start with a mentality of growth. So you're growing your capital. So every time you get small amounts of money, you can always invest in these stocks. You can always come and add. You can always reinvest your dividends, which is also a good way to diversify. So the one secret I would always encourage investors, whether you're starting, whether you've been in this for some time, would be diversification. So make sure you're not keeping all your eggs in one basket.
Then when you say they shouldn't put their eggs in one basket, that sort of, to me, sounds that there are what we can call overlooked risks, right? There are probably risks that early investors or beginner investors sort of overlook. But for you as BK Capital, you're regulated, under Capital Market Authority and maybe Stock Exchange, right? But how can these first timers, right, protect themselves if that exists?
So there are very many regulations. So for us to be able to open your account, there's some forms that you have to fill, of course. So there's the KYC, there's email indemnity. So all of that protects you as the client. As a client, you're always protected. So for some of the risks, I would say maybe mistakes early investors make
Yes.
would be buying to sell. So whenever they put their money, they always feel like they put emergency. So don't always put your emergency money into shares because of the high volatility, the high risk. The stocks are usually a steady growth. So they do not rarely happen overnight. They do not rarely give you that profit that you would have gotten if you were to invest in 6 months, in a year, if you were to invest overnight.
In terms of time periods, is there a specific, like, let's say 6 months is like the least time you should be expecting to make profits?
No. So there's not, you can still buy today and sell after the stock settles. You're not time bound. So you're not really restricted by how long you should keep the stock for. But we usually advise that if you want to see the value of the stock go up, increase in value, increase in also the dividends as well. So if you're to buy today and sell tomorrow, you won't get your dividends. So you will definitely not see the capital gain because with the market, especially the market in Rwanda, so that's the one I'm really adamant on. The market in Rwanda is steady. It's a steady growth. So the price today most likely will be the price tomorrow. So in other mature markets outside of Rwanda, you could buy a stock today and tomorrow the price has tripled, right? But for the one in Rwanda, it's a steady growth. So that's why the risks are a bit lesser than the ones in mature markets. But still, so if you're to buy today at 460, most likely the price tomorrow or the price in 3 days will be, maybe if it has gone up, it will go to like 465 or 462. And so if you want to see that growth, if you really want to see the value of your stock go up, would advise to have it maybe 3 months and beyond. But we are not really restricted to how long you should keep that stock for. So if you are comfortable with keeping it for a week, it's really your choice.
Now, talking about choices, I've had conversations with people, individuals, but also institutions. And usually they have lots of speculations around how the market operates, right? For retail investors, yeah, how best do you help them, or what should they consider to make informed decisions?
So it's very key to make sure that you're reading up about the company that you're planning to invest in. But secondly, also ask questions. Especially with growing markets, we don't have as much information on ground. I would say that, but we do have the stock exchange, so it gives the financials. It gives if there's any announcement, they'll always put it.
This conversation usually takes 15 minutes, right?
Yes.
But if anyone has been, for people that have actually been following this conversation, if they should forget everything but remember one thing, what is that one thing that they should remember?
All right. One thing I would recommend, and to keep in mind, diversification. Diversification is the key to a successful investment plan. So now going into the 5 to 10 year strategy, diversify. So don't put all your money in one stock. Second, I would say make informed decisions and also start with as little as you can.
Well, Diana, thank you for, of course, allowing space and time to have this conversation.
Of course,
Yeah,
pleasure.
that is Muson Diana, who is in charge of wealth management at BK. My name is William Evans. Of course, I told you that the Capital Market Bridge Show scales the heights to bring you conversations that matter. Like you heard from Diana, you have to begin small, but also do not keep all your eggs in the same basket. William Evans, see you next time. Goodbye.